There's an unspoken law in the financial world that separates the real players from the crowd. The smart money always moves first. While ordinary investors chase yesterday's gains, the true masters of wealth read tomorrow's disasters in today's data. They don't hope for the best, they prepare for the inevitable. And when chaos strikes, they don't just survive, they thrive. What I'm about to reveal will fundamentally change how you see the greatest financial catastrophe in American history. Because the crash of 1929 wasn't a random market failure. It was the most sophisticated wealth transfer operation ever executed. A surgical precision strike that moved billions from the naive to the prepared. The smart money didn't just see it coming, they orchestrated it. And while millions of ordinary Americans lost everything, a select group of financial titans made generational fortunes. Today, you'll discover exactly how they did it and why. The same patterns are emerging right now. This is the story of the billionaires who turned Black Tuesday into their greatest payday. To understand the greatest wealth transfer in history, you need to see 1929 through the eyes of those who mattered, the real players who controlled the game while everyone else played checkers. Picture America. In 1928, the Roaring Twenties were in full swing. Stock prices had tripled in 5 years. Ordinary investors were borrowing money to buy more stocks, convinced the party would never end. Taxi drivers were giving stock tips. Shoeshine boys were talking about their portfolios, but the smart money was reading different signals. While the crowd celebrated, the real players were watching credit markets tighten like a noose. They saw margin debt reaching mathematical impossibility. They observed forced liquidation patterns that always preceded major collapses. Joseph Kennedy, future patriarch of America's most powerful political dynasty, was quietly liquidating his massive stock positions throughout 1928. Not because he was pessimistic, because he could smell the smoke before the fire. Bernard Baruch, the legendary financier who advised presidents, had been systematically reducing his market exposure since early 1928. When asked why, he simply said, "I'd rather be out wishing I was in than in wishing I was out." Jesse Livermore, the most feared trader on Wall Street, was building the largest short position in history. While everyone else was buying, he was betting against the entire system. These weren't lucky guesses. These were calculated moves by men who understood something the crowd never would. Markets don't crash by accident. They crash by design. The real players had access to information that ordinary investors never saw. They sat on bank boards. They controlled credit flows. They knew exactly how much leverage was in the system and exactly when it would break. But here's what really separated the smart money from the crowd. They didn't just predict the crash. They helped create the conditions that made it inevitable. Now, I'll reveal the systematic strategy that turned market collapse into the greatest profit opportunity of the century. Phase 1. Strategic positioning throughout 1928. While ordinary investors were buying on margin and dreaming of easy riches, the smart money was executing a coordinated repositioning that would define the next decade. Jesse Livermore began building short positions in September 1928, a full year before the crash. But this wasn't random speculation. Livermore had identified the mathematical breaking point of margin debt. When 90% of stock purchases were being made with borrowed money, he knew the system was primed for controlled demolition. Joseph Kennedy was even more surgical in his approach. As a major stockholder in several banks, he had access to lending data that revealed the true fragility of the system. Kennedy didn't just sell his stocks. He systematically distributed them to smaller investors who were hungry for hot tips from a Wall Street insider. Think about the psychology here. Kennedy was literally selling his positions to the very people who would be wiped out when those positions collapsed. It was wealth transfer disguised as investment advice. Bernard Baruch took a different approach. Instead of shorting stocks, he moved his wealth into government bonds and gold, assets that would appreciate when everything else collapsed. Baruch understood that crashes don't just destroy wealth, they concentrate it. Phase 2. Market psychology. Manipulation, but the real genius of the smart money wasn't just in positioning, it was in controlling the narrative that kept ordinary investors buying all the way to the top. Throughout 1929, while privately liquidating their positions, the financial elite publicly promoted optimism. Irving Fisher, the most respected economist of his era, declared that stocks had reached a permanently high plateau just weeks before the crash. Was Fisher incompetent? Or was he playing his role in keeping the crowd invested while the smart money escaped? The evidence suggests coordination. In the months leading up to October 1929, major financial publications, controlled by the same interests that were secretly selling, published increasingly bullish forecasts. The message was clear: any dip was a buying opportunity. Meanwhile, the real players were reading different data. Credit was tightening, margin calls were increasing, foreign money was fleeing American markets. But this information never reached ordinary investors. They were fed a steady diet of optimism while the smart money prepared for slaughter. Phase 3, the controlled demolition, October 24th, 1929, Black Thursday. The day the smart money's patience was rewarded with mathematical precision. But here's what they don't teach in history books. The crash didn't start with panic selling. It started with coordinated liquidation by those who mattered. Jesse Livermore made $1.5 billion today. But Livermore wasn't just lucky. He had positioned himself to profit from the exact scenario that unfolded. His short positions were perfectly timed to capture maximum profit from the systematic destruction of over-leveraged positions. Joseph Kennedy's timing was equally surgical. Having sold his stock positions throughout 1928 and early 1929, Kennedy used the crash to buy real estate, media companies, and distressed assets at fire sale prices. Kennedy didn't just preserve his wealth during the crash, he multiplied it by acquiring the assets that desperate sellers were forced to liquidate. Bernard Baruch's strategy proved equally brilliant. While stock investors lost 89% of their wealth over the next 3 years, Baruch's government bonds and gold positions appreciated dramatically. Baruch had positioned himself to benefit from the flight to safety that he knew would follow the crash. But the most revealing detail of all, these men didn't just profit from the crash. They used their profits to buy control of the very institutions that had collapsed. Banks, newspapers, radio stations, manufacturing companies, all acquired at pennies on the dollar by the smart money that had seen the crash coming. The crash wasn't just a market event. It was a transfer of ownership of American capitalism itself. The mathematical inevitability, what made the smart money so confident, wasn't insider information. It was pattern recognition that ordinary investors couldn't see. Every major market crash in history follows the same mathematical progression: excessive leverage, credit tightening, forced liquidation, panic selling, wealth concentration. The smart money of 1929 had studied the panics of 1907, 1893, and 1873. They understood that markets don't crash when things are bad. They crash when things are too good, when leverage reaches unsustainable levels and credit begins to contract. By 1929, margin debt had reached 90% of market capitalization. This meant that a 10% decline in stock prices would trigger massive forced selling as over-leveraged investors faced margin calls. The smart money didn't need to predict when this would happen. They just needed to position themselves to profit when mathematical inevitability played out. Jesse Livermore later wrote, "The market was like a house of cards built on quicksand. We didn't cause the collapse. We just refused to pretend it wouldn't happen." The modern parallels. Here's where this story becomes terrifyingly relevant to your financial future. The same patterns that preceded 1929 are emerging today with surgical precision. Corporate debt has reached record levels. Margin debt is approaching 1929 proportions. Credit markets are showing the same tightening patterns that preceded every major crash in history. And just like in 1929, the smart money is positioning itself while ordinary investors chase momentum. Warren Buffett, the modern equivalent of Bernard Baruch, is sitting on $157. billion in cash while publicly stating that he can't find anything to buy. Buffett isn't waiting for better opportunities. He's waiting for the liquidation, sale that always follows excessive leverage. Ray Dalio, founder of the world's largest hedge fund, has been warning about paradigm shifts while positioning his fund for currency, devaluation, and asset deflation. Dalio isn't being pessimistic. He's being mathematical. Jeff Bezos has liquidated over $10 billion in Amazon stock over the past 2 years. Not because he's lost faith in his company, but because he understands that even great companies become cheap during forced liquidation events. The smart money always moves first, and it's moving now. The wealth transfer mechanism understanding. How the billionaires of 1929 made their fortunes reveals the eternal mechanism of wealth concentration. Leverage creates vulnerability. Vulnerability creates opportunity. Opportunity creates generational wealth for those positioned correctly. The ordinary investors of 1929 weren't stupid. They were simply playing a game where they didn't understand the rules. They believed that rising prices meant increasing wealth. The smart money understood that rising prices meant increasing risk. When the crash came, it wasn't random destruction. It was systematic wealth transfer from the leveraged to the liquid, from the hopeful to the prepared, from the crowd to the smart money. Jesse Livermore's $100 million profit didn't disappear into thin air. It came directly from the losses of ordinary investors who had bought what he was selling. Joseph Kennedy's real estate empire wasn't built from nothing. It was built from the forced liquidation of families who could no longer afford their mortgages. Bernard Baruch's bond profits weren't market magic. They were the mathematical result of capital fleeing from risk assets to safe havens. Every dollar gained by the smart money was a dollar lost by someone who didn't see the pattern. The preparation advantage. What separated the winners from the losers in 1929 wasn't intelligence, luck, or even insider information. It was preparation versus hope. The ordinary investors hoped the good times would continue. The smart money prepared for the inevitable correction. The ordinary investors borrowed money to buy more stocks. The smart money preserved liquidity to buy assets during the liquidation. The ordinary investors believed the narrative of permanent prosperity. The smart money studied the mathematics of unsustainable leverage. When the crash came, it wasn't a surprise to those who mattered. It was a harvest. The billionaires who profited from 1929 didn't have crystal balls. They had something more powerful. The understanding that markets are cyclical, leverage is dangerous, and preparation beats hope every single time. Your position in the next transfer. The question isn't whether another 1929-style wealth transfer will happen. The question is which side you'll be on when it does. The smart money is already positioning. Corporate insiders are selling at record rates. Hedge funds are building cash positions. Central banks are preparing for unconventional measures. The signs are everywhere for those who know how to read them. But here's the brutal truth. Most people will ignore these signs, just like they did in 1929. They'll continue buying because prices are rising. They'll continue borrowing because credit is available. They'll continue hoping because the alternative is too frightening to consider. And when the transfer happens, and it will happen, they'll lose everything to those who saw it coming. The smart money doesn't hope for the best. It prepares for the inevitable. The billionaires of 1929 understood something that ordinary investors never learned. Wealth isn't created during good times. It's transferred during bad times. The greatest fortunes in history weren't built by riding bubbles. They were built by positioning for the collapse that always follows excessive leverage. The pattern hasn't changed in 100 years. Only the players have. The question is, will you be smart money or ordinary money when the next transfer begins? Because it's not a matter of if, it's a matter of when, and the smart money always moves first.